Obviously, real estate was always intriguing because there's so many wealthy millionaires and billionaires that did it through real estate. But not everybody could just dive into these big projects. So one of the first things I learned to do was to pack your money into a guaranteed life insurance policy first. So as much as they'll let you put in, and then you use that as leverage for your other investments. So what I did is I just said, well, okay, I got to.
Hello. Welcome to another Knowledge Bomb episode of Lead to Greatness, where we believe in helping others reach their greatest potential and together change the world. Today on Lead to Greatness, we have Dan Thompson. If this is your first time joining us, please consider subscribing and hit that notification bell and hit that like button. This will be greatly appreciated in helping getting out this content to great leaders and great individuals like yourself. Dan is a financial expert, speaker, author, investor, business owner, and entrepreneur. He is the owner and founder of Wise Money Tool, Eagle Capital Manager, and Oakmount Signature Homes. Dan is committed to provide financial knowledge to help build wealth and income for his clients. Please help me welcome Dan with how to leverage life insurance to build wealth. This is Cedric Francis, and you're listening to Lead to Greatness.
Started as a stockbroker in '86.
Wow.
And it just kind of evolved to where I kind of got away from traditional financial planning for many reasons in the late 90s. And here I am today. So been at it 38 years. We do all kinds of fun stuff. Mid '86. And my first experience, you might have heard of the crash of '87. It was I think the single biggest percentage drop in history.
Wow.
And I've only been in the business, 4 or 5 months at the time.
Oh my goodness.
And that hits. And I'm like, oh, I was just paranoid. What am I supposed to do? What am I supposed to do? Luckily, by the end of the year, it was already, kind of made its way back. But then we had the 94 recession, the dot-com boom and bust of the 90s. Then we had 08. And so, I mean, there's always, seems like every 10 years, there's 1 or 2 years in there that are going to throw you. Think about this. When I first started, we had prime at 9%. We had money markets paying 9%.
Wow.
Mortgages were 10 and 11%. So I know mortgages are a pain right now. I actually own a building company as well. Wow. And so we build houses, and we've seen that slow because of mortgage rates. But still at 6 or 7, that's a dream compared to the 10 and 12 that we had in the 80s. When I was a teenager, I was landscaping houses and framing houses. And the builder I was working for, they were building a house where the guy was going to pay $250,000. and this is like a 6,000 square foot, 5-bedroom, 4-bath. I mean, big lot. And I can remember shoveling that dirt and just saying, there's no way I'll ever be able to afford a $250,000 house. And now I can't get a starter home for
Right, exactly. Amazing. I want to talk about Wise Money Tools. How did you get started with that?
Well, after the dot-com boom and bust of the 90s, I just felt obligated to my clients to find a better way. So for a good couple of years, I was looking at everything under the sun. What else could you do? Obviously, real estate was always intriguing because there's so many wealthy millionaires and billionaires that did it through real estate. Yeah. But not everybody could just dive into these big projects. So one of the first things I learned to do was to pack your money into a guaranteed life insurance policy first. So as much as they'll let you put in, and then you use that as leverage for your other investments. So what I did is I just said, well, okay, I got to prove this out. I got to do it myself. So I started doing it myself, just putting as much as I could. And then what I did is I began to lend money to a builder. And so I was using my policy as leverage to lend to a builder and make the spread. Well, this builder's saying, "Dan, what are you doing? You're crazy lending it to me. Why don't you just go build houses yourself? Light bulb. Okay, I'll go do that." And so what I did is I turned around and hired him to be my project manager, so to speak.
Oh man.
Anyway, so we started building houses and all this coming from life insurance. And then since then, I pack in as much as I possibly can. Just a little while ago, I bought a student housing complex at Texas A&M, buy office complexes around town, got rental homes, all these different things. We're always on the hunt for multifamily, but it all started with building a base and a foundational safe place to store your capital in a tax-free environment, and then leverage into other things. And now we leverage into assets that will help reduce, if not eliminate, people's taxes, cash flow, passive income. So it's just kind of ballooned from there.
Wow, leveraging. I definitely want to get into this conversation. Let's start here because banks have this thing called a fractional reserve, right? And where I come from, my dad always told me to save. But there's just something about saving. Out of my savings account, it's a very small percentage. But let's start off talking about fractional reserve. What is it and how does it benefit the bank and how does it benefit the person who owns the money?
Well, fractional reserve is just nothing more than a bank being able to leverage the amount of assets they have by as much as 9 or 10 times. So if a bank opens up their charter, let's say they put in $100,000 and then they just loan out that $100,000 at 5, 6, 7%, it's probably not going to get them anywhere. Yeah. But when we start putting money in the bank as depositors, they can leverage that. So they can basically loan out 10 to 1. So if I put $100,000 in the bank, they can loan out $1 million.
Wow.
So now, a 5% return to a bank can be a 30, 40% return because they're leveraging the money that we put in there. Well, we can't necessarily go and do fractional reserve, but we can do the same kind of thing with life insurance, because if I pack the money in a life insurance policy, I don't have to take it out to use it. I can get a line of credit against it and go use that line of credit for my investments or to buy things or whatever. And so now my money's still working in the policy and I've got it working in real estate or equipment or whatever else I do. And so I can get that same dollar working 2, 3, 4 times. And that's about as close to fractional reserve as we get. But here's the key. We don't ever want our money to stop. I don't want to beg too much on, Dave Ramsey, but he's this cash guy, don't ever go into debt. Don't ever borrow money. There's a difference between borrowing for debt and borrowing for leverage and financing.
Say that again. I agree. And I would say, even with Dave Ramsey, I don't have anything against Dave Ramsey, because the truth of the matter is Dave Ramsey did help me to a certain point. I mean, when I was on the other side, but I mean, the snowball effect, all that was really great. But yes, it's at that certain point. I'm like, okay. I agree with you. You helped me get here, but helping me get here won't help me get there. So go ahead.
Yeah, no, you're exactly right. And I have the same feelings as well. I don't have anything against him. And he does help a lot of people who've gotten buried in debt. Yeah. And I get that. And we don't want people buried in debt either. Yeah. But we don't want them putting good, productive money into wasteful assets. So cars are the perfect example. If I save and go pay cash for a car, that money's gone forever. Yeah. It's in the tires and wheels, and every mile I drive, it gets worth less and less and less. The way I like to ask it is this. Let's say I got this stock and it's $10 a share today, and I guarantee you in 5 years, it's going to be worth $5 a share. How much you want to buy?
None.
None. Yeah. Well, that's a car, right? And so to pay cash for a car, sounds like you're going to save some money. But what would be better is if you had the money that you were going to put in the car go into an income producing asset, let that asset pay your car payments. Yeah. And so we let the assets pay for the liabilities, and then the money's always working 24/7, for the rest of our lives. We never take it out of work.
Yeah.
We're
And,
employing the money every day.
and you know what? And I'm glad you talked about that because passive income. I want you to talk more about that because you just mentioned the car and creating the income to fund the car. I want you to talk about more of that and what does that look like?
Yeah. So passive income is, I like to call it mailbox income. It's going to hit your mailbox whether you're, ready for it or not.
Yeah.
The problem is most of us, we trade time for money in employment. And that's it.
Yeah.
You're trading your 8-10 hours a day. You get a paycheck. That's it. So
Yeah.
now what you got to do is you got to get your money to be employed and go work for
Yes.
you, creating passive income.
Yeah.
Real estate, equipment leasing, any kind of e-commerce. You can be a lender. There's so many ways. We sometimes just leverage life insurance on life insurance on life insurance, and we start to create this passive income stream. And more importantly, we do it in a tax-free environment, because here's another key. Taxes are the single largest bill that any of us will pay. So one of the best ways to get a great return on your money and build your wealth is to reduce or eliminate your taxes. That alone is going to give you an amazing rate of return, and you don't even have to hardly do anything for it.
Yeah.
But the idea is just getting your money employed outside of your employment so that you've got two of you working at the same time, you and your money.
Wow, wow, wow. This is good. Knowledge bomb. I have to, you mentioned this 3 times already. So let's dig. You keep saying packing into insurance. I want to slow down a little bit and I want you to explain to us type of insurance we should be looking for. And when you say packing into insurance and getting the loan off the insurance, explain to us 101 packing into insurance. I want you to give us a class.
It's pretty simple. So there's term insurance and there's permanent insurance.
Okay.
Term insurance is just you pay a premium. If you die, you get it. If you quit paying premiums, there's nothing left. Whereas a permanent type policy, this can be whole life, it can be some sort of a universal life, but the idea is your cost of insurance, let's say, is $1, but they let you put in $10. So you get to pack it full of cash, and it becomes kind of I call it my storage facility. This is where I'm going to store capital until I have a better use for it. So the insurance company, based on your age and your health and all that, they're going to let you put in so much into a policy. And by the way, what a lot of people don't know is there's a limit. You get to a point where you can't put any more into a policy, even if you wanted to. I'm begging these companies, please let me have one more policy.
Wow.
But we pack it up right up to the IRS guidelines. And then because it's such a safe and guaranteed asset, it's the easiest asset to leverage. So all I got to do is either call up the insurance company and say, hey, will you send me some of you don't even get your money. You just say, will you send me some money? They'll use your policy as collateral, send you some capital, go do your investment. Over the past 20 years, it's been easy to get banks to do that because bank rates were even lower. I could call up 2 or 3 of our banking relationships. They'll give me a line of credit using my policy. Now I've got a checkbook and I can go do anything I want with it. It's guaranteed. It's safe. The bank never has to worry about it. And we don't pay it off. It's going to sound kind of morbid, but we don't pay it off till we exit the planet, until we die. We're going to use that money every day until we die.
Wow, Dan, that is some knowledge bombs. Really, really, really. Here it is. And I just want to clear this up. If you have packing the insurance or packing the savings account, which one would you do?
Well, I definitely want to pack the insurance if at all possible. You want to either be putting in monthly to pack it, or if you have a lump sum, that's obviously even better. But the reason why you want to pack it in the insurance policy is because you kind of also kill 2 birds with 1 stone. Hopefully none of us ever have that tragic event where we die before we're kind of expected to, but you create an instant estate for your family as well. So you're protecting your family while you're packing the policy, while you're packing away your cash, and then you still get to use it and leverage it and still keep your family protected and all that good stuff. Here's the best part. You're doing it in a tax-free environment. If I do it in a savings account, I'm going to be taxed on that interest that they give me every year. Inside of a life insurance policy that's well designed and is designed for cash value, you'll never pay tax again.
Oh man,
You're
Dan,
shaking your head there.
you're dropping some knowledge. We've been taught the traditional way of putting money in the savings account. And there's someone right now that's listening. They rather see in the savings account rather than packing in the insurance account. What would you say to that individual?
Well, I would say in a bank, you're FDIC insured, which means if the bank went under, the government or somebody's going to print some money and get it back to you.
Yeah.
In a life insurance policy, your money is actually guaranteed. That life insurance company has dollar for dollar ready to pay you back and your beneficiaries if you were to die. To me, it's the safest place you can have your money on the planet. And then if you have the need for it, it's the easiest one to access. Well, I guess the savings account's easy too, but it's a very easy way to access capital for your investments at the same time.
Dan, why is no one talking about this? I mean, all we hear is the savings account aspect of with the banks. I mean, why are we not hearing about this?
I think you got a couple things going against this, and one is Wall Street.
Okay.
Wall Street would rather have your money in 401ks and IRAs and all those kinds of things. They don't want you to control your destiny. And then the other is just the banks. I mean, the banks, control the universe, so to speak. If you start looking, there's a huge movement toward using your cash value policy for leverage, for other investments. I've got 4 books out there now, but there's a lot of books that compete with me, so to speak, on this principle. Now, I will say we do it much differently because so many of them are still kind of promoting using your policy to go buy a depreciating asset like a car and then just pay yourself back, kind of like you're your own bank.
Yeah.
And that's okay, but we really like to leverage into things that are going to build your wealth even faster.
Danny, I want you to do 2 things. I want you to talk about, because you mentioned your books and you're giving us this valuable information here. So I want to know what books you have, right? The next thing I want you to do is you talked about those other ways to leverage your asset. I want you to talk a little bit about that as well. But first of all, I want you to talk about, you say 4 books. I want you to talk about a few of them.
Yeah. So each book got a little bit progressively better, as hopefully we do in life. And my latest one is called The 4 Keys to Building Wealth. And that's where I talk about time, leverage, compounding, and tax savings. And when you mix those 4 things together, you got a powerful way to build your wealth, to manage your money, to create passive income, and to do it, in a tax advantage way. So I wrote it so that it could be read in an hour to 90 minutes. It's just real simple, to the point. And then we talk a lot about this on my YouTube channel of the same name, Wise Money Tools. I think there's over 500 videos now out there.
Wow.
Where we've been talking about this for a decade or more. So good ways to get educated, get your feet wet, and then, see if it's something you want to dive in and see how it works in your situation. Reach out to us, because what we do is create a design for them. So that design is designed to show what leverage would do. And then we can work with them on some ideas of other things that they might leverage into. They may have an idea for themselves. By the way, this is awesome for business owners. It's a great cash management tool. It's a way to continue to grow your business. We work with a lot of medical professionals as well who own their own practices. This is great for all of those. Anybody who's looking to, again, create that passive income outside of their own work abilities, all this will fit very nicely into that kind of a portfolio. We have a lot of our clients get their teenage kids in it.
Wow.
And they get their first job and they can save $50 a month or something like that. So the parents, depending on if they're a minor or not, might have to own the policy outright or at the beginning. But then the kids pumping in money. And in fact, I just had one the other day. He came up for his annual anniversary. He's 17 years old. He puts in $4,000 a year. And I think he's up to $16,000 or $18,000 now. And he's talking about how to get his first house here in a little while.
Wow. Wise Money Tools. Do you guys kind of counsel them, and even the 17-year-old, is he kind of steered by information you guys giving them, or you guys consulting with the family, the parent or the guardian, and they tell the child? How does that
Yeah,
work?
typically we're working with the parents first, and
Okay.
then they're saying, "Oh, I got to get my kids involved in this." Oftentimes we'll be working with one parent, and then all of a sudden a brother or sister comes in, and then an aunt and uncle, and next thing you know, we got 10 or 12 family members all trying to work together in finding assets and things like that. So it's kind of fun. But we have advisors all across the country. We're set up with about 30 or 40 staff members who do nothing but help us with designs, help with the financing side. So yeah, we're pretty geared up to handle just about anything out there.
Awesome, awesome, awesome. Then, what are some misconceptions that people, hear, or rumors they hear, and they kind of step away from until they find out the truth that it's not what they thought it was?
Well, probably the biggest ones, and it's true in the beginning, and that is the cost of insurance is a little more expensive
Mm.
in a permanent insurance than term. And
Okay.
that's very true. I mean, if I'm 30 years old and I get $1 million term policy, it's going to be nothing, right? Because my
Yeah.
life expectancy is 50, 60 years from now.
Yeah.
The problem is they never tell you the real truth, and that is that term policy is going to get so expensive by the time you're 60, you're probably going to drop it because the premiums are going to be so high. If you happen to be 70 or 75, forget about it. You'll pay more into it than your death benefit will be.
Jeez. Yeah.
Premiums are so high. So in the beginning, yeah, it's a little bit daunting because the costs are a little bit higher. But as you go through that 3, 5, 7, 10, 12, 15 years, it becomes one of the least expensive insurance policies you'll ever have. But more importantly, you got to work that cash value all along the way, and you'll build your wealth far beyond what you would typically do in a 401k or some sort of retirement plan because you get to control it along the way.
I don't want to dig too much into the 401k, because when 401k first started, I do want to dig into it, but not too much. But then when the 401k first started, I mean, it was they sold it real good to us, right? The 401k, but this is something that just recently happened. I know an individual that retired this year. It didn't quite benefit him the way he thought it would in the beginning, 15 years prior.
Oh, yeah. I'll tell you, I could give you 401k disaster after disaster.
Yeah.
Here's the worst one is that, and this guy's a perfect example. If today you were looking at your tax bracket and you're going to defer your tax today, well, none of us know what our tax bracket's going to be in 15 or 20 years from now.
Yeah.
We could be in the lowest tax bracket we'll ever be in. This would be the day to pay the tax.
Mm.
Well, here's what's happening. We're seeing so many people as they retire in higher tax brackets than they were when they saved the money.
Wow.
So they're saving it at 15% just to take it out at 20 or whatever those numbers are. It's
man.
it's a disaster. But the
reality.
401k was kind of, the pension used to be the thing, right? But that was all employer sponsored. The employer paid for that. The 401k let the employer off the hook because now
Yeah.
it's all on the employee.
Yeah.
They got to save the money. And unfortunately, again, because of the way tax deferral works, and worse, the volatility of the markets.
Yeah.
I can't tell you how many people I talked to in 07 who were ready to retire and by 08 had to go back to work because their 401ks were now what I call 201ks.
Yeah.
They were cut in half with the market.
Yes.
Too
Yeah.
hard to make that work. Just control the outcome and you can control your wealth. You'll control your income. So many good things you can do outside that.
Yeah. Since we got into the 401k, I want to kind of compare this. So 401k versus what you were talking about with the insurance packing. How can an individual right now, what can they do, or is there any type of way they can benefit the insurance versus the new traditional 401k?
Oh, absolutely. Yeah. Just leveraging your life insurance over the next 5, 7, 10 years will produce more income than you probably would get off of a 401k.
Well, but 5 years is not that long. I mean, you said 5 years.
No, a lot of our clients are in a situation where they can put a lot of money in up front, and they can start taking income in even as little as 3 or 4 years. But I like to kind of say 5 years as a good runway.
Yeah.
But more importantly than that, if they leverage into assets that are going to help them tax wise, I don't want to get too deep, but there's a tax deduction out there called a 179 deduction. And if you buy the right kind of assets, it can reduce your taxes dramatically. So my first objective is to eliminate my clients' taxes. And if I can do that, they got so much more money that they can save and invest. That alone is just an awesome rate of return.
Wise money tools. Dan just said the first objective is to save you on your taxes. I mean, this is really good, Dan. I really love what you were saying, and I love what you were doing. I want to ask you this. For wise money tools, what can a client expect in the onboarding phase?
You know, we're a very white glove hand holding type of a situation. We'll take a short intake form, not a lot of details, but then we'll build out a design so you can see it just right in black and white, what we think that this is going to do for you. From there, once we get the policies start working and get them packed, then we start looking out to some of our strategic partners. What can we do with some of these funds? And that all depends on their risk tolerance and the things they want to do and the things they're interested in. But we'll start to branch out into things that would, again, create more passive income for them, potentially give them even more tax deductions and tax advantages. But yeah, it's a handhold, white glove all the way.
Wow. This is good. This is Dan. This is good. You're a lifesaver, and you're definitely going to change the financial trajectory of a lot of the listeners on today. So we definitely thank you with a big knowledge bomb for that amazing information, just dropping knowledge after knowledge after knowledge. I want to ask you this. If someone wanted to connect with Wise Money Tools, what should they do, or what's the process?
Yeah, they can stop at the website, wisemoneytools.com.
Okay.
And there they can even we have a complimentary copy of my newest book, The 4 Keys to Building Wealth. You can also just go experience some of the things we're talking about on the YouTube channel of the same name. We're on TikTok, Facebook, Twitter, Instagram, everywhere else. I'm either as Wise Money Tools or Wise Money Dan. And we got hundreds of shorts out there. We got the longs. Anything you want to know, we've probably talked about it on a video.
The Wise Dan. And the man. If someone wants to connect with you and what you're doing personally, where should they go?
Oh, just email me directly, dan@wisemoneytools.com.
Oh man, amazing. Dan, before we go, I have a last question for you. What are some practical leveraging growth tools, tips, and advice that you can share with the Lead to Greatness community to help us reach our greatest potential?
You know, I think the first thing is just to get prepared to think outside the box. Traditional financial planning is just not working. The save 10%, put it in a 401k, all the things we've been talking about this, last half hour, it's just not working for people. So if you can just be prepared to think outside the box, look for some alternative ways that literally the wealthy have been doing for generations, and incorporate some of those things, you'll find it's not as difficult as you thought it was.
Knowledge bomb. Dan, thank you. On behalf of the Lead to Greatness community, we want to thank you so very much for taking time out of your busy schedule and adding value to us all.
Oh man, thanks for having me. This was fun. Hope it was helpful. Reach out anytime.
We want to thank you for joining us today on the Lead to Greatness podcast. So remember, if you help others reach their greatest potential, together we can change the world. Peace.